If you've been watching the market over the past 2 years, you know it hasn't been easy. Volatility, rising interest rates, inflation fears, geopolitical tensions, investors have had to navigate one of the most uncertain environments in recent memory. But now, something interesting is happening behind the scenes. Major Wall Street firms like Goldman Sachs and Morgan Stanley are beginning to shift their tone. Analysts who were cautious not long ago are now turning bullish, and not randomly. They're focusing on three specific sectors they believe could outperform the broader market in 2026. The big question is, what are they seeing that most retail investors are missing? To understand this shift, we first need to look at the bigger economic picture. Over the past few years, whilst the biggest pressure on markets has been aggressive rate hikes led by the Federal Reserve, higher interest rates increased borrowing costs, slowed business expansion, and compressed stock valuations. But heading into 2026, expectations are changing. Inflation has cooled significantly compared to its peak, and the rate hiking cycle appears to be near its end. When rates stabilize or even begin to decline, it creates breathing room for corporations. Financing becomes cheaper, earnings projections improve, and investors are typically willing to pay higher multiples for growth again. That macro shift alone can change market momentum. At the same time, we're entering a phase where artificial intelligence is no longer just hype. It's becoming embedded into the real economy. Over the last few years, companies experimented with AI tools. But now we're seeing full-scale integration into business operations, from automation and logistics to healthcare diagnostics and financial services. This transition from experimentation to monetization is critical. Wall Street analysts believe 2026 could be the year AI moves from a growth narrative to a profit engine. And that brings us to the first sector analysts are bullish on: technology, but not in the way most people think. This isn't just about buying popular tech stocks because they're trending. Analysts are focusing specifically on AI infrastructure, the companies providing the backbone of this transformation. Firms like Nvidia, Microsoft, and Advanced Micro Devices are positioned at the center of enterprise AI expansion. Nvidia supplies the advanced chips powering AI models. Microsoft integrates AI into enterprise cloud platforms and productivity software. AMD competes aggressively in high-performance computing. The reason analysts are optimistic is simple: demand is no longer speculative. Corporations are signing long-term contracts, governments are investing in digital infrastructure, and cloud providers are expanding data center capacity. That creates recurring revenue, higher margins, and stronger earnings visibility, the exact ingredients institutional investors look for before upgrading a sector. But technology isn't the only area catching Wall Street's attention. The second sector gaining momentum is energy, and this might surprise some investors. For years, energy was considered cyclical and volatile, often avoided during periods of economic uncertainty. However, a structural shift is happening. Underinvestment in oil production over the past decade has tightened global supply. Meanwhile, geopolitical instability continues to support commodity prices. Companies like ExxonMobil and Chevron have transformed their financial strategies. Instead of reckless expansion, they are focusing on capital discipline, dividend growth, and aggressive share buybacks. In a stabilizing rate environment, that combination becomes very attractive to institutional investors seeking both income and stability. What's even more interesting is that many traditional energy companies are investing heavily in renewable and transitional energy solutions. This positions them to benefit from both conventional oil demand and the long-term energy transition. Analysts see this dual exposure as a strategic advantage going into 2026. Energy is no longer just a commodity trade. It's becoming a cash flow machine with shareholder-friendly policies. That's a powerful narrative shift. Now let's move to the third sector. Analysts are upgrading healthcare. Historically, healthcare has been considered a defensive sector, something investors rotate into during uncertain times. But in 2026, it's more than just defensive, it's defensive growth. The aging U.S. population continues to increase demand for medical services, treatments, and insurance coverage. At the same time, biotech innovation is accelerating at an impressive pace. Companies like Eli Lilly are seeing massive demand for breakthrough therapies, while giants like United Health Group continue to expand their service, ecosystems, and profitability. Healthcare offers something unique: resilience during downturns and expansion during recoveries. Regardless of economic cycles, people need medical care. Insurance premiums continue to flow. Drug innovation continues to advance. Analysts appreciate sectors where demand is relatively inelastic, especially when combined with strong earnings momentum. That's why healthcare is increasingly viewed as a strategic core holding rather than just a temporary defensive play. So why are analysts turning bullish now instead of waiting for markets to fully recover? The answer lies in forward earnings expectations. Institutional investors don't react to today's headlines. They position themselves based on where they believe profits will be 12 to 18 months from now. Earnings revisions in technology infrastructure, energy, and healthcare have started trending upward. Capital flows into sector-focused ETFs are increasing. Insider buying in certain industries has picked. These are early signals of institutional rotation. However, it's important to stay realistic. Bullish does not mean risk-free. Technology valuations can become stretched if growth slows unexpectedly. Energy prices can fluctuate due to global supply shocks. Healthcare companies face regulatory and political risks, especially during election cycles. Smart investing requires diversification and risk management, not blind optimism. The bigger takeaway here is this: Wall Street isn't randomly choosing sectors. Analysts are responding to macroeconomic stabilization, structural industry shifts, and improving earnings visibility. Technology is benefiting from AI monetization. Energy is benefiting from supply discipline and shareholder returns. Healthcare is benefiting from demographic demand and innovation breakthroughs. When you combine those forces with a more stable interest rate environment, you create the foundation for potential sector outperformance in 2026. The question for investors isn't whether these sectors will move overnight. Markets rarely move in straight lines. The real question is whether you're paying attention before the broader crowd catches on. Institutional money tends to move early, quietly building positions before headlines confirm the trend. As we move deeper into 2026, watch earnings reports, guidance revisions, and capital allocation decisions. Those signals often reveal where smart money is concentrating. Whether you're a long-term investor or actively managing a portfolio, understanding sector rotation can make a significant difference in performance. Because at the end of the day, investing isn't just about reacting to news. It's about anticipating where growth, cash flow, and stability will converge next. And according to Wall Street's latest positioning, technology infrastructure, energy and healthcare may be leading that charge. The opportunity may not be obvious to everyone yet, but the signals are starting to align. And in markets, positioning before consensus often makes all the difference.